And a very good afternoon to everybody. Welcome to the Horowitz Company pop-up Q&A webinar for October 12th, 2020. I hope everybody's doing well. I hope you're having a good week. You had a good week, and we're here to talk about a lot of things that are probably on your mind, especially as we're getting much closer to the election, and to try to get a little bit of better understanding of what's happening with the news. I'm Andrew Horowitz. And I want to let you know that this is a time where you have the opportunity to ask any questions that you want related to finance and money and markets, and maybe even some outlook of what your thoughts are, and maybe provide some comments. We do this each and every Monday, and we get together. We've been doing this since March to try to understand a little bit about what's happening with some of the things that are going on with relation to the pandemic, the recession, the non-recession. Now we're getting into election season and, of course, earnings season, looking at the economics behind all this, trying to really discern where we should be positioned, and, again, answering your questions. The whole point of this is to really spend time together helping you. The idea is to allow for and open access to questions. So anything that you want to ask, please put it in the Q&A panel on the bottom, and we will do our best to get to it and try to understand it. No question is too small. No question is insignificant. I want to make sure you understand that, and that you feel comfortable that you could ask anything you want along the way. What we usually do, and just give you a little heads up on how this works, is we go over some of the things that are kind of important in the news, some of the things that are really putting forth the reasons why we're seeing some of the action in the markets, what they mean, try to decompile them, and then give you the opportunity to ask away anything you want. As always, I want to mention that nothing that we discuss is to be considered a recommendation to buy or sell any security, and past performance is not an indication of future results. This is to be assumed to be educational in nature, everything that we talk about, because nothing is legal or tax, accounting, or investment advice that we talk about today. So with that, let's start talking about what's going on with the markets. And clearly, I think we have to welcome, I guess we can call it, certain uncertainty. Every day there seems to be a new reason why there is a change in the market's mood from despair to euphoria, because we have news flow that is nonstop. It is what is used to be a long time ago, this idea that we had a news cycle that was, a week long, where you can get the information and try to decipher it and understand it, research it. Then we started hearing about the 24-hour news cycle, not only 24 hours in time because of the internet and because of the communication that's available, not 24 hours a day, but 24 hours and things change. Now we're on a hour-to-hour news cycle, which is pretty amazing. We have this news flow that goes from the pandemic and the concerns that we see in Europe to what's happening in the Midwest, to regional lockdowns that we're seeing in various parts of the world that markets don't seem to be concerned about. We're seeing that this increase in the new case count, and however you want to deal with what that means, less overall hospitalizations and death rates that are being held back a little bit due to the fact that we have some basic medicines right now that are helping along. Plus, we know what we're dealing with a little bit more right now. But any of the bad news that's coming out also does not seem to have an impact on markets. In fact, nothing COVID concerning seems to be at all a worry to the markets. And maybe it's because there's some thought that we're closer than we were before to a vaccine. Maybe it's because the worse the situation gets, the higher the likelihood is that we will see further stimulus put into not only the United States economy, but around the world, because we're seeing that not only we're seeing trillions of dollars of fiscal stimulus, money that's a direct injection into the markets, into the consumers' pockets here in the United States, but around the world, rates are the lowest they've been pretty much in history. And governments are very much desirous of popping up the economy the best that they can and pouring in all sorts of money directly to the consumer. The news flow also right now is all about the election. We have the debates. We had that one presidential debate that was just off the hook. We had the recent vice presidential campaign debate, which was, by all accounts, calm and, might I say, kind of boring as compared to what we saw in the presidential. There was a lot more substance in the vice presidential debate, no question about that. That's the only one they're going to have. The presidential debate that they were going to have this week, scrapped. The concern about President Trump being contagious and saying, you know what, if you do want to have this debate, you're going to have to, come with a clean bill of health. I don't think he wants to really find out whether or not, or at least not tell everybody whether or not he still has the COVID virus, even after the miracle cure. And I think that there is a concern that was very, very short term, that the spread of COVID and this infection and this whole situation was spreading along and around the White House very quickly. And what would that mean? But now that the president seems to come out of this feeling 20 years younger after all the medications, and while they were experimental and used for emergency uses, and he was hopped up on steroids, things seem to be a lot better than they were. Whereas he had now, 74 years old, overweight, where that would have been possibly a death sentence, or at least a long-term hospitalization back in March, April, May. Now it seems to be that situation is much different. And I think people are really looking at that and saying, maybe it's not as bad as we thought. And that's why we're seeing a positive reaction in the markets. Now, whether or not that's true or not is an entirely different story. The average person does not have access to military helicopters to take them to a hospital where they get the dedication for an entire floor and an entire team of, a dozen doctors and probably a slew of nurses and all sorts of other people that are attending to his needs on a daily basis, not getting the emergency use authorization for medicine. So it's a little bit of a different situation. And of course, it's appropriate for the leader of a country to get that naturally. But even in that situation, didn't seem to be a concern for more than about 24 hours. Now, what's really kind of interesting is right now, all the talk that we have seen over the last number of months, that if for somehow, some reason, some way that Vice President Biden gets elected, the stock market's going to crash. Because Biden is going to be increasing taxes. He talked about the taxes will increase on people earning over $400,000 per year, that the corporate tax rate's going to roll back from what President Trump and was agreed upon by Congress recently, down to the 21%. It's going to move back up to 28% or so. The rollbacks of the rollbacks of the rollbacks of the deregulation and the regulations are going to be pushed back. We're going to see carbon once again in the bad category, and some of the clean energy bills start to build again, kind of leading off where he left with Obama into where we are with President Trump. But even that, the idea of higher taxes, which is market negative, the idea of rolling back the rollbacks of the regulations, which theoretically is market negative. None of that seems to really impact markets too terribly. I mean, you would think by the very nature of the idea of taxes going up on corporations would clearly crimp profitability, and earnings would be an issue. And now that we have, I'm going to use a questionable commentary right here, but now that we have the polls that are showing the widest margin of potential victory by Biden, which we have to put that into the category of do we believe the polls or not. But let's just go with this for a second, because markets have to dig into something, right? They need to bite into something that they can believe in. And whether or not we look at the economic numbers and say, well, I don't know, is that really true that we have a 7.9% unemployment rate when we see that the labor participation rate is so low? Well, the markets, they get right in on that. The data is what they look at. The data is what is cued in terms of what we are going to look at from the perspective of the markets, the valuation. Do we really believe that many of the companies that came through this pandemic and the worst recession we've seen in decades really are doing that well? I mean, S&P earnings are going to be down 20% this year, and here we are 3% from an all-time high across the board in major indices. Not to mention some stocks that are at their all-time high. Not to mention that the NASDAQ is up 20-something percent for the year. Dow Jones Industrial Average somewhere close to even. In a time where earnings are down. But remember, markets have to grab onto something. Markets have to trigger off of some kind of data. So the data right now is showing us that Biden is in the lead, and therefore it has to be assumed that we follow that through to its obvious conclusion that if he wins, what's going to happen? The taxes are going to be raised on corporations. But then again, why aren't we seeing the impact of markets with that being the case? And I'll tell you why. The reason is that unless there's some crazy and cuckoo-natured methodology going on here, the fact that a raise in taxes right off the bat in the midst of a very high unemployment situation would hurt, once again, the employment situation is probably not in the cards. While there is a lot of talk about raising taxes, while there is a lot of talk about rolling back some of the rollbacks of the regulations, undoing some of the deregulation that went on, the probability is it's not going to happen right away. More probable is the fact that if a stimulus plan is not enacted in time for the election, which Mitch McConnell said is not going to happen just a couple of days ago, there's probably going to be stimulus sometime after the election, or I would say by the end of the year. The first call will be to make sure that there is stimulus because it is in desperate need for a lot of people that are out of work and are really hurting. There's a major difference between the haves and the have-nots right now that have been impacted by the pandemic. We know this. We talked about the K-shaped recovery. So here we are in a world that the probability from the polls, again, use that as you may, is that there is going to be a change of command at the top. But the big issue we really need to focus on is not so much who is going to be president, but what is the rest of the government going to look like? Are we going to have a Democrat in office as the president and a split Congress again? Because that is usually a pretty good indication that not everything will get done. There'll be some pressure from one side or the other. And that is usually market positive. Are we going to see a blue wave or a red wave? Those kind of things are much more impactful because that is where you see a lot of changes happen. Markets don't like a lot of changes. Status quo is good. But again, what we're seeing right now is something that I could probably liken back to what happened during the China trade talks. Remember that? Where every day there was another reason why this won't continue. Every day it was on, and then it was off, and then it was changed, then it was bigger, then it was smaller. The tweets were flying, and there was constantly a change in one thing or another. Remember, just within a week, President Trump said, hey, you know what? We're only doing about 1.5, 1.6 trillion. Democrats came back and said, hey, you know what? We want 2.2 trillion. We're not doing it. President Trump said, you know what? The hell with it. Cancel all negotiations until the election. Markets sold off 2% that day. The next day, President Trump said, let's get back to the drawing table here and see if we can negotiate something. Maybe we'll do a standalone deal just for the airlines. The Democrats came back and said, no, that's not going to happen. Mnuchin, Pelosi, they talked again. Then comes out a comment from McConnell saying, you know what, I don't think we're going to get this done by the time the election happens. The next day, President Trump says, you know what, we'll go to 1.8 trillion. like we're buying a house, right? This is like, okay, you know what, if you're saying 2.2, I'll start at 1.5, then I'll move it to 1.6 maybe, and you'll come down at 2.1. This is all negotiation, like there's something being bought here, not actually helping people for what they need. And both sides are negotiating, and both sides are being political in the process. There's no question about that. Both sides know something needs to get done. The Democrats believe that the longer they hold out, the worse it looks for the president, hoping that their candidate gets in. The president knows that if he gets in, well, it looks good for the Democrats because he didn't get the deal that they wanted. But yet they know that at the same time, they can't hold out because the election's right around the corner and a lot of people are suffering. And those people are going to be pretty pissed off if they don't get some kind of relief moving forward. So this on again, off again, off again, on again is this situation that we saw in the China deal. And maybe this is some kind of negotiating tactic to help the markets, to throw the markets offside one way or another, and then get back into it, showing that, yeah, we're really willing to do this. I don't know what the technique is, how it works. I can tell you, for whatever it's worth, right now, everything market-oriented is about the stimulus. The process that's going on right now, this push and pull and pull and push, on again, off again, do it, don't do it, higher and lower. Somehow, the markets believe that there will be a deal done. And somehow they like the process. And the longer we go, the more the potential is for something to actually happen. So they're kind of reading through and trying to see where that's going to be and handicap the amount that's going to be actually put out in terms of stimulus. But it is market positive at this point, even though it seems to be a pretty crazy process. Now, I've gotten a lot of questions over the last week. People have called me and asked me the question, you know, what should I do with my portfolio now that we are getting close to the election? And my comments have been just exactly what I talked about here, that we are in a situation where, number one, we don't know the outcome. Number two, it doesn't make sense to try to get ahead of the trade because there's so many potential variables involved here in actually what the makeup of the government looks like after the election. If we assume that we don't have a contested election, if we assume that things are going to go very easily and a handoff of power will happen and it's going to go if Biden wins or if Trump wins. Now, one of the things we also know, there's probably going to be a good amount of civil unrest one way or the other. We know that people are getting prepared for this. We know because we can see that gun sales have been rocketing. I know people that are trying to buy guns, they can't even get them. They're out. We know that ammunition prices have gone up considerably over the last several months. So where we are is in a very important place in the history of our country right now. I'm going to stay with the country, forget the rest of the world. And I think a lot of what is going to make things, I don't want to say better, but we do need this stimulus to take care of the people that are hurting right now. And I think markets are keenly aware that something's going to get done. Especially that now we have some of the economic conditions softening. We can't get below this 850,000 new unemployment initial claims on a weekly basis, even though the unemployment rate came down. We're seeing that some numbers are getting a little bit softer, some a little bit better, but we would have assumed that this was the case after that sharp drawdown that we saw the second quarter. So a lot of the things that we're seeing, these bounce backs that we're seeing right now, are to be assumed would have happened anyway. Because just when you get business back to normal a little bit, even a 25% or a 50% increase from zero is a lot when it comes to occupancy at a restaurant or a hotel or some people starting to fly from a 90% overall year-over-year decrease in passenger traffic to only 70%. That may not seem like a big deal, but that's a big deal in a 1 month, 2 month span. So right now where we are is an economy that really needs this stimulus, that the people that are out of work need some kind of help, and markets are sniffing this out. And that's why, long story short here, is why the markets are not seemingly concerned with any of the other interim news that's going on right now that a lot would have expected. That's why even with a Biden lead, as far as we can tell right now on a nationwide basis, utilizing every poll data that you could find, would have initially been the death knell to the markets, right, with taxes being raised. But still, let's be clear that the data right now doesn't matter. We're going to start seeing that earnings are coming out starting this week. Tomorrow morning, we're going to see several of the major banks start to report. Now, with a yield curve that has been uncooperative, loan loss provisions on the rise, rates as low as they are, that has not been a good environment for banks. Big question is going to be, okay, knowing all that, where are we with respect to the loan loss provisions that you're banking, that you see moving out the next 3 to 6 months? Are you increasing those because you're seeing that businesses are hurting? And are you seeing that consumer credit is starting to deteriorate? What is it that the banks can tell us? Because that's going to be a great forward look on the health of the economy and the consumer and the businesses that are out there, even though at the end of the day, one of the things that we're going to see is that the Fed is going to stand behind many of these zombie companies, these small cap companies that don't have the revenue and earnings to pay down their debt service, but they keep on borrowing. We see that. We know that's going to continue. So right now, it's going to be a really good read through over the next several days. This week, when we see 6 or 7 major financial institutions, the banks, the Goldman Sachs, the Bank of America, the Wells Fargo, the Morgan Stanleys, these are all going to report this week, and it's going to be very interesting to see how this goes. So remember, right now the data doesn't matter. Right now there's a bet going on in the markets that taxes could be raised if Biden comes in, but it won't be right away, that the stimulus will be a much greater overall, have a greater overall impact on the markets than even the potential for a long-term tax raise. And markets are really focusing on the next few weeks, not necessarily the aftermath of that. So that kind of gives you a good setup of where we are right now, what's happening, where we're going. A couple things I want to mention. We're going to get to the questions. First of all, do me a favor, put your questions in the Q&A panel. We'll get to those. I'll mention we had a really good discussion, I think, this week on a lot of things we talked about here, but also about prep time. It's time is now to prep. So with all the things that we know here from what we just discussed, what do you do with that? How are you prepping? Should you be out of the market? Should you be in the market? And a lot of people that I've talked to this week are really concerned. Hey, you know what? What should I be doing? We talk about that and how to prep yourself for what's coming, whatever that may be, in this week's podcast. We had a great guest last week or the week before, Dr. Richard Smith. We talked about the psychology of the market, the TikTok deal. What happened to the TikTok deal? Where is that? Well, we don't even hear about that anymore. It was in the news every single day. I guess it's just we'll see what happens, I guess. And then, of course, tomorrow night at 9 p.m., we're going to be talking with John C. Dvorak on DH Unplugged, where we have a live podcast stream as well as a chat room where you can play along with us. Also find the Disciplined Investor podcast on Apple and Amazon and Spotify and Podchaser and Podcasters and anywhere you can find podcasts, as well as DH Unplugged as well. So let's get to some of the questions. We have a number of questions that are in there. And first question comes from John. And John asks, he says, hey, do you think value stocks are finally ready to start doing well? And if not, when? So that covers a lot of area, John, the whole idea of value stocks. You know, we've been slightly tilted towards value stocks over the last year or so. Not happy about it, but still believe that they would provide us some downside protection, which they really didn't, frankly, during the market sell-off. And then, if in fact we saw a better rate environment, they would do better. Right now, we are in a momentum chasing market, looking for tech and healthcare, because that's the play when you don't have growth anywhere else. Value, you're talking about energy, you're talking about the banks, you're talking about utilities, maybe even some real estate. The problem is specifically the biggest sector of your value play, right? Energy has just not been doing well. Ever since we saw that implosion of crude oil back a few months ago where it hit, negative 40 per barrel? It really damaged a lot of the energy companies. Banks, again, we talked about that a moment ago, not able to really do well in an environment with very low interest rates. Now, interest rates have been picking up a bit, even though the Fed has acknowledged that they are probably going to hold this ZIRP, zero interest rate program, out to 2023. But recently, they've been really talking about the idea that they need help. They need fiscal stimulus. And they've been pounding the desk and cheerleading for that. And I think that tells us, the read-through is that there's just so much that monetary policy and stimulus from low rates can do. It can't really help the employment situation as is wanted. So do I think that value stocks will do well? I think, yes, there is the definite possibility, especially if Biden comes into office. And if, in fact, we do see a potential for a hike in taxes, and if we see that the economy does a bit better, the yield curve starts to expand, potentially if there are finally an infrastructure plan in terms of stimulus in the infrastructure area, that could be a good play. I still think you need to be balanced between both sides. Again, we're overweighted a little bit towards and tilted a little bit towards value for our large caps. I think that long term, we will see a reversion to the mean trade, and it will be dramatic when it happens. Next question. Some individuals are afraid of socialism. We now have a dictator. I'm just reading the question. Don't shoot the messenger here. I'm just reading. Some individuals are afraid of socialism. We now have a dictator. Vote for me and get your stimulus package. I lose the election, wait till next year. But we will have a new judge on the high court. Well, yeah, I mean, that is a little bit of politics in action right now. And if we kind of get rid of the whole socialism idea, because I don't really think, I don't know where that whole thing is coming from. The whole dictator thing, we'll put that aside too. Let's get to the next thing. The current president is saying, hey, you know what? If you vote for me, we'll get a stimulus package. I lose the election, wait till next year. Totally agree with that being a major political push from what they're doing. Yes, no question about that. And obviously trying desperately under all circumstances to have who they want on the court. The timing, unfortunately, of Ruth Bader Ginsburg's death. Along with this, I mean, they're making a case that this shouldn't happen because it's not right, because the citizens should vote. And the fact is, we have a president that is in right now. That president has the right to appoint. You may not like it. It may not feel good. You may feel like they should wait because it's the nice thing to do. But there's nowhere in the Constitution that says that they have to wait. So they're going to try to push this through and get this done. Let's just be honest. Aaron writes, I'm catching up on the podcasts. Recently, you were discussing the equity allocation that went down precipitously as the screening took place. My question is, what do you reallocate money as you lower your equities? ETFs, short-term money markets, gold, silver? Aaron. So I think what Aaron is referring to here is that in September, the beginning of September, the TDI Managed Growth Strategy, which is a long-short strategy, which we use for diversification, where people that don't want to necessarily have a full exposure to the markets, an S&P 500 only kind of long exposure, just long only, will utilize this as a way of diversifying their portfolio. What we do is we have a core equity allocation, which is what he's talking about. Plus, we have some hedging, we have some short-term trading, we have swing trades. What he's asking me here is, since in September, we ran our screens, and every 3 months we rotate, and we were only able to find 22 stocks out of about 5,000 that were able to meet the criteria of We have a lot of criteria, but examples would be a certain level on return on equity. We want to see margin expansion. We want to see earnings growth and 10 different indications to make it into the screen. What do we do? Well, right now what we do is we have cash. Cash is our buffer. We don't necessarily say, okay, take the rest and put it into gold or silver. No, that's not what we do right at this point. Right now we're looking at cash as the hedge because what we're finding is stocks are unable to meet these criteria. Therefore, what it's telling us is a few things. Number one, valuations are in question. You have stocks with almost at all-time highs, but yet we can't see how you have a consistency in earnings growth. How does that work? Number two, the idea that if only 22 stocks, and we usually have about 50 or so, 22 stocks meet the criteria and we drop our overall allocation down to, let's say, 30% equities, then what is that telling us about the rest of the environment with regard to how things are operating in the background? Right? If companies aren't able to meet these criteria, what is going on? And why are stocks going up? They can go up for a period of time, but for how long? So I think what we're saying here is that we're willing to take a few months off of our equity exposure to see how things play out. And maybe things will change next quarter and we'll be ramped right back up again. But until that time, we're not willing to put our money to work necessarily just absolutely. Now, we take some of that money and we will do trading with it. We will have maybe hedging with it. We will have a swing trading with it. You know, we're going to do things with the money, but we're not going to commit it to an absolute, hey, we're investing this money, even though these stocks don't make sense at this point. All right, we have a couple more questions. By the way, everybody, you probably have something on your mind. You're listening. You want to ask something, ask away. This is your opportunity to do so. A lot of people out there. Like I said, I'm still surprised that we have a packed room. We have a packed webinar here. And what I find amazing is almost 6 months after we had this downfall where we were thinking about just doing this for a short period of time, so many people have so much interest in this. And I want to thank you for that. I want to thank you for your courage. We'll talk of no agenda language here. For your courage for coming and participating, bringing your great questions, because a lot of your questions that you have on your mind, probably a lot of other people have on their mind. So I ask you to help out in this discussion. Help out with the participation because we all learn something from all of this. All right, let me get to the last two questions unless there's any more. Well, there's a comment. I'm for limiting House and Senate to 3 terms. All right, I got it. I'm with you. Question about the KRI indicator. This is the key reversal indicator that I use. We developed something a number of years ago to find out where markets are starting to get a little bubbly, a little frothy. Because you can look at just a stock chart and see, okay, the S&P is going up. It looks like it's going up a lot. And does that mean something? Or the Dow Jones is going down a lot. And what does that mean? Does that mean something? But where is that point? Where is the point really where you can say, well, you know what? It's overdone, either to the upside or the downside. Where it is a level that we see that says, you know what? Maybe it's a time that there's blood in the streets and let's invest a little bit of money here. Or maybe it's a time that, it's possible that maybe we should pull money off the table, or if we were doing some quote unquote market timing, not committing a massive amount of capital to any kind of quick swing trade in any direction or the other. So the question is, the KRI is specific to SPY, which we utilize on the TradeStation trading app store and trading TradeStation platform, and is specific to the SPY because it's just one index that we use as a part of keying off some of the information that comes into the calculation to formulate this. So the question goes on. Investors rotate investment to different sectors. Like right now, the market is tech heavy. Is there a need to create KRIs for the Dow and the QQQ? Not really, because what we use is actually NYSE data. We use S&P 500 data. We use put and call ratios. We use a variety of different things inside of there. The S&P is just kind of a place marker for that. Does it really matter about the S&P if that's up or down? It really is more important about the rest of the psychological indicators that we put into it. And we use a lot of different ones inside to score. And what we do is we use each individual one, come up with a score, add it, divide it, put some algos into it, comes out of the process as a number from 0 to +7 or 0 to -7. Only once did I see a -7. Oh no, I've seen it a couple times. Only once did I see a +7. When we saw that +7, it was with 1 day or maybe 2 days, but I think it was 1 day. And I noted on Twitter. You have to follow me on Twitter. We'll put those up there when they get to about a +5, which they hit today. We're at a +5 overbought. Now, is that absolutely like get out of Dodge and sell everything and get the hell? No. +6 gets me really worried. And especially when we have several days in a row that we have over a +4. You start getting into that situation, the idea of where we are right now. And when you look at the combination of not just a one-off 1 day, but a multitude of days, and we get these clusters forming. So we had right now 4 data points above 4%, +4, and a cluster forming to a +5 today, where we're getting readings of overbought significantly. So I don't think we need to use the Dow. We thought about all those components, but it's not necessary in this situation when we utilize the SPY as just 1 point, and that's all you're really seeing there. That's not really just the SPY. It's the market in totality. Think of it that way. Good question, though. Nancy writes, posted your podcast slogan, filter, step away. So relevant for portfolio and nonstop political blitz. Yeah. That I talked about that. Yeah, the whole idea of get your nose off the screen, back up a little bit, step away for a second, filter the information, and let's kind of let it all machinate a little bit and come together to understand what's going on. But right now, yeah, Nancy, that there is something on the idea of that you can't. Right now, the news flow is so intense. What would I say? It's like trying to take a sip out of an open fire hydrant. It's impossible because whatever the news is, it's like the weather in Florida. You don't like the weather, it's going to change in 5 minutes. And it just did. I walked in the studio. It was nice out. It's raining out right now. That's true. Right now, the political blitz, the news flow, the back and forth, and let's be honest. I'm not the biggest fan of, if we want to call it transparency, of a president and senators and Congress people and all the political people out there, governors, having total and free access to Twitter. I just don't think that things are well thought out and all. In fact, if a CEO of a company did the same things the politicians do about, we're going to have this go down and we're going to do this and we're going to do that, they would probably be arrested. The SEC would be all over them, but not with politicians. They get to say whatever they want. All of them. No matter how insane it is. And who knows what their real purpose is, but we know to get elected, right? That's the purpose. To stay in office. So right now, I think that's great. Thanks for mentioning that. Filter it and step away. Step back away from the screen and kind of turn some of it off in the background. Limit your intake for a little while, especially till after all this is done. David asks, what are your thoughts on the Fed-based Bitcoin being kicked around? For a while, this whole idea of a decentralized common currency that is digital for the Fed was something that was out there. And oftentimes you see this start to crop up when there's a bit of a lull in the Bitcoin news, and it takes Bitcoin up pretty well. Bitcoin right now is trading close to, 12,000, I think. And this is up significantly. Let's see if I can pick it up. Bitcoin right now is 11,576, up 1.78% for the day. And just about a week and a half ago, it was right at 10. Let's see, 1, 2, 3. 3 weeks ago, it was hovered right about 10,000. So it's up about, what is that, 10, 12% in the last week or so. I think, Bitcoin's a tough one because it's thinly traded. It's not really heavily regulated. A lot of people push and pull. There's a lot of big elephants out there that are moving stuff around. I can't imagine the Fed getting away from the US dollar. They may do something from the aspect of tracking, utilizing the blockchain rather than necessarily a digital currency. It would seem highly unlikely. I know there's talk about China going that direction. I know there's talk about Europe, the Eurozone and the ECB talking about some of this. A lot of talk about this for a long time. I don't think it's going to be a great idea. Right now, the differential would be what? Cash versus digital currency. Now, bank robberies ended many years ago, but Bitcoin, where Bitcoin accounts are being compromised are happening on a regular basis. I mean, we saw that Robinhood accounts last week were also compromised, and a lot of people lost a lot of money. So anytime you go digital in this world that we're in right now, it creates the potential for a lot more unsavory operations. The only reason the Fed would want to possibly do that is to get into the tracking business of cash, because the cash has a whole underworld involved in utilizing of cash. I don't think that underworld and a lot of people that utilize cash will really want to look to utilizing something that's trackable. There's something about having a wad of cash at your house during times of strife. Hurricanes hit and all the, you lose your Visa card and all that, or the terminals are down, electricity is down, communications down. You still have cash you can use. Bitcoin in the bunker? Probably not. Cash, gold, and of course, my favorite is tuna fish in oil. Canned tuna fish in oil in the bunker. If you never heard me talk about that, I'll give you a brief lowdown. Basically, you know what? You're in the bunker, you got gold. What do you do with it? When you shave off a piece and give it to somebody to give you some water or something? You have cash. Maybe it's usable, maybe it's not. But tuna in oil. You open up the can, you use the oil as maybe a fuel. You could use it to maybe, you can moisturize yourself, use it as a possible sealant. You could use it for lighting. You got the tuna. You got that as a nutritious value. You then have the top, which you can use as a weapon or a tool. Then you have the tuna in the can. You could use that to maybe accumulate water from the rain. Use it as a cup. Use it as a pot. So many more uses for tuna in a can than there is for either Bitcoin or gold or even cash in the bunker. I'm not kidding about this either. So the idea of going down the bunker and schlepping a 200-pound brick of gold with you or something, or coins, or maybe even silver, I don't know. And the idea of using Bitcoin, how do you even use it if the world ends? If the world ends, there's no communication, there's no way to transfer it. Internet, it doesn't work. So I'm not really a fan of that, and I just don't think the Fed's going to go that direction anytime soon. Anyway, that ends our questions. I want to thank everybody for joining us. You can get in touch with me, of course. My email right there, info@horowitzco.com. Our phone number is right there as well. If anybody wants a portfolio review, if you want to talk about things that are going on, if you want to check out what's going on with the managed growth strategy, there's great video over on thedisciplinedinvestor.com. Just scroll down, see our strategies, click on the Disciplined Investor TDI Managed Growth Strategy, and it'll take you through to see a really cool virtual walkthrough video. Thanks for joining me. We're going to end it now, and I'm going to see you again next week.